Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the bearish counter attack pattern, a powerful reversal signal that can help you identify potential market tops with remarkable accuracy. This two candlestick formation has consistently precise significant price reversal across multiple currency pairs, and mastering it could be the key to improving your trading entries. You will discover the exact criteria for identifying this pattern, learn the precise entry and exit points, and understand why many traders miss this high probability setup. By the end of this video, you would have a complete strategy for trading the bearish counter attack pattern, including risk management rules that can help protect your capital. Now, what is this bearish counter attack? This bearish counter attack pattern emerged during an uptrend and consists of two distinct candlesticks that signals a potential reversal in market direction. The first candle displays strong bullish momentum characterized by a long green candle body. The second candle opens higher than the first one but faces intense selling pressure, pushing price down to close near the previous candle's closing point. So this is exactly of the exact pattern we should be looking out for in an uptrend. For this pattern to be valid, several conditions must be aligned. The market must be in a clear uptrend showing higher highs and higher lows. The first candle needs to maintain a sustained body size indicating buying pressure, while the second candle must gap up at the open, demonstrating initial bearish sentiment, but close near or at the first candle's closing price, revealing the bear dominance. So this is a pattern on my chart. First of all, we are in an uptrend. As we can see, price is making a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and a high. So we are in an uptrend, which is the first and most important thing. Then we can spot our pattern in this area, and we can see that we expect a reversal of price. Okay, the psychology driving this pattern reflects a significant shift in market control. When the first bullish candle forms, buyers appear to be in complete control, pushing price higher with confidence. The gap open at the open of the second candle initially supports this bullish sentiment. However, sellers enter with overwhelming force, demonstrating their ability to absorb all buying pressure and driving price back downward. This dramatic reversal is price action suggests that the previous uptrend might be exhausted and a new downtrend could be forming. This pattern becomes particularly significant when it appears near a key resistance level or after an extended upward move. It creates profitable trading opportunities. Now, to effectively trade this bearish counter-attack pattern, you need a systematic approach that combines precise entries with proper risk management. The key to success lies in waiting for the pattern confirmation rather than entering trades immediately after the pattern forms. Your entry point should come after a confirmation candle. Specifically, enter a short when the market breaks below the low of the second candle of this pattern. This approach helps you to avoid fake signals and provides a higher probability setup. Stop loss should be placed to protect your capital. If we are to enter this trade, remember we are to enter after the third candle has formed. We will place our stop loss. Stop loss placement is crucial to protect capital, placing our stop loss just above the high of the second candle. Let's not forget, just above the high of the second candle. This level represents the point where which the pattern would be invalid, as any move above this would neglect the bearish sentiment in the market. To take profit targets, you have two strategic options. The first target should be set at a previous swing low. The previous swing low should be the first TP area, which often provides a reliable profit taking level. For larger move, extend your target to the next significant support level using a risk to reward of at least 1:2 or 1:3. You can extend your profit target level to the next swing low, or you can target 1:3, 1:4 as the case may be. Remember, position sizing remains critical to your success. Never risk more than 1 to 2% of your trading capital on a single trade, regardless of how convinced the pattern appears. This ensures that even a series of loss won't significantly impact your trading capital. Remember to always check the higher time frame trend and key support and resistance level before entering any trade. The pattern becomes significantly more reliable when it forms at a major resistance or support or overextended upward move area. Now let's look at the common mistakes to avoid while taking this strategy. Why the bearish counter pattern can be a powerful tool, many traders make common mistake that reduces its efficiency. By avoiding these common mistakes, you can significantly increase your chances of success. One of the biggest mistake is entering the trade without confirmation. Like we said, many traders see the two candle formation and immediately jump into the trade expecting an instant reversal. However, not every bearish counter leads to a significant price drop. Always wait for confirmation candles. Always wait for the confirmation candle that breaks below the low of the second candle before entering a position. This simple step can help you avoid false signals and unnecessary loss. If you can see a false signal at this area. If we had taken this trade at this area, the moment we saw this our candlestick pattern, we took the trade without any confirmation, price would have just gone in our direction for a short while before reversing on us and taking us out on our stop loss. So we have to always wait for confirmation before taking this our signal. Another mistake is to ignore the overall market context. The bearish counter is most effective when it occurs within a large technical framework, such as near a key support or resistance level, or after an extended uptrend. If you try to trade this pattern in a sideways or a chubby market, you will more likely get caught in false signals. Always analyze the broader market structure before trading this signal. So if we see this particular pattern in a sideways moving market, as we can see from this area, this is a sideways moving market, and I can spot this pattern inside this area. Seeing this means that we need to avoid trading in this sideways moving market. to avoid caught up in false signals. Traders also frequently mismanage their risks by setting an inappropriate stop loss or risking too much capital per trade. Always place your stop loss. Placing your stop loss too tight can result in getting stopped out by normal market fluctuations, while risking too much on one trade can lead to significant losses. Always place your stop loss above the high of the second candle, as you can see from my screen, to avoid being stopped out by market fluctuation. And always risk 1 to 2% of your account per trade. Finally, failing to consider higher time frame objective is another mistake that can lead to poor trading results. A bearish counter attack on a lower time frame may not hold much weight if the higher time frame trend is still strongly bullish. You have to check the higher time frame to ensure that you are trading in line with the dominant trend and increase your reliability on this strategy. So let us check what we mean. We check our higher time frame, such as our daily or our 4 hour, to confirm this strategy. We can see we are in a bearish market, so this pattern has more significance. We are trending in the down direction, so it is supported by the downtrend of the market. By avoiding these common mistakes and sticking to your disciplined approach, you will be able to maximize the potential of the bearish counter attack pattern and improve your overall trading performance. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.